Hello and welcome to this week's W4.0 Weekly Roundup. I'm John and with me, as always, is Neil Woodford. Today's lineup covers a lot. We'll begin with the surge in the UK 30-year gilt yields and then dive into what Neil has dubbed UK hysteria, before we shift on to France's political and debt tensions and then wrap up with Nvidia's latest earnings and what that might signal for the AI boom. Let's get started. Neil, 30-year gilt yields are approaching levels last seen in the late 1990s. What is driving the surge and why does it matter for the UK economy and for investors today?
Yes, the UK gilt yield has risen to a pretty high level, 5.6%, and that's the highest yield we've seen since the late 90s. And a lot has been written about this. I think it might help people to understand why this has happened, just to give a bit of context. So there are some oddities about the UK gilt market. UK defined benefit pension schemes, which were effectively the biggest owners of the UK equity market 25 years ago, have shifted their asset base significantly towards government bonds, essentially. And the peculiarities of their long tail liabilities meant that they had a particularly strong appetite for very long dated gilts. And as a result of those pension schemes wanting to buy lots of long dated gilts, the government issued a lot of long dated gilts. If we job forward now to today, apparently the demand from those defined benefit pension schemes for long dated gilts has diminished. And that's partly because the volume of asset reallocation has declined. They've got the gilts effectively that they need. And of course, over time, the inevitable sort of death of members of those schemes means that they diminish in size. So the demand from those defined benefit pension schemes for those ultra long dated gilts is declining. Now, the government needs to be aware of that and needs to moderate its issuance of long-term gilts. But there's a further oddity about the UK gilt market which is worth mentioning. The average duration of the UK government bond market is about 14 years. That is a very long-term debt maturity profile. For example, the US's average debt maturity is 6 years, and the 14 years of the UK's debt book compares very favourably with almost all other of developed economies around the world. So we've got a very long-dated book of government debt, and it's largely because of this very large and strong appetite for these long-dated gilts from pension schemes. Now, what's driving yields up now is partly a fact that the demand for those gilts has declined, but also because it's not necessarily because of issuance. It's also because the Bank of England has been involved in reversing the quantitative easing that it engaged in post the financial crisis. So essentially, the gilts that it bought during QE, it's now selling back to the market effectively through a QT program, a quantitative tightening program. Now that has helped to shift the supply and demand balance for long dated gilts, some of which are being sold back to the market. Now, through a combination of these factors, this has pushed up 30-year gilt yields. Now, lots of people are writing about this and saying, well, this is very worrying. This is symptomatic of an impending debt crisis in the UK. Again, it's part of the sort of hysterical debate about the challenges confronting the UK economy right now. I'm not diminishing those challenges, but they're nowhere near as hysterical as many journalists have written in recent weeks.
Is this a transient spike or is this the start of a structurally higher cost of borrowing for the UK?
No, it is not a symptom of structurally long-term higher borrowing. The fact is that the government's debt management office has the flexibility to issue gilts across the maturity curve. So as I've tried to explain, if for specific reasons 30-year yields have gone up significantly for technical reasons, then the government's debt management office doesn't need to issue 30-year gilts to fund the deficit. It can issue much shorter dated gilts where yields are much lower. The average maturity of the UK's debt book is much longer. It's twice as long, more than twice as long as the US's debt book, for example. So there's loads and loads of flexibility to issue debt at lower yields for shorter maturities. And with regard to those shorter maturities, for example, the 10-year gilt yield, my view is that those yields, although higher than I would like in the short term, and to some extent linked to US bond yields, which are also relatively high. There's a small premium in UK gilts over the equivalent 10-year yield in the US. But fundamentally, my view is that as UK interest rates, official interest rates, those set by the Bank of England, continue to decline, they've obviously come down recently to 4%, as they continue to decline over the next 12 months, so the 10-year yield will follow that yield down. And I expect 10-year yields to be yielding something like 3.5% in about a year and a half's time. So again, unfortunately, the financial media are literally in sort of meltdown mode. Some areas of the financial media are in meltdown mode.
Last year, I thought we were headed for an IMF bailout. I think that's even truer now than it was a year ago. And we're in an economic doom loop.
They've been writing about IMF bailouts being imminent, a collapse of the UK economy, its inability to fund the deficit. This is all hysterical nonsense. The government has lots of flexibility to issue debt at much lower maturities. It doesn't need to issue debt at the 30-year maturity point. The demand for those long-dated gilts has declined, as I've said, for reasons that are very obvious. So the government debt obviously understands that, knows that, and will start to issue shorter dated gilts to fund the deficit. And there's one other point, which is the Bank of England can just stop QT. And if it stops QT, it will reduce the supply of gilts into the market, take the strain off the market, and this will help. The yields to come down. So the Bank of England's QT program is creating a bit of a headache for the Chancellor. If I was the Chancellor, I'd be ringing up the Governor of the Bank of England and asking him why he feels he needs to continue with the QT program, because it's increasing the cost of debt for the entire UK economy. So anyway, it's another self-defeating sort of immolation problem that we've got in the UK. So anyway, stop QT, doesn't need to continue, reduce the pressure on the gilt market, reduce interest rates, 10-year yields are going to come down, and we don't need to fund the deficit by issuing 30-year debt. So the problem is much more manageable than people are thinking. The level of hysteria is extreme, in my view, at the moment in the financial media. The reality, as I keep saying, is that the UK economy was the fastest growing G7 economy in the first half of this year. Growth is likely to accelerate going forward as interest rates come down, as inflation declines, and as global uncertainty, particularly in relation to trade, begins to ease. I can see lots of reasons why that acceleration in growth might actually exceed my own expectations. The UK household sector is saving an unprecedentedly high level of income, and already is sitting on a giant pool of savings. So much so that now household sector deposits significantly exceed household debt, indeed by about 320 odd billion pounds. So, the UK household sector is primed to start increasing spending. All it needs is a bit more confidence in the economy, a bit more confidence in the management of the economy effectively, and a little more clarity and certainty around the government's tax policy, which I've written about in recent blogs. Really, although I'm very conscious of the challenges, the level of hysteria is troubling me. I mean, it is hard to explain quite why some journalists think that we are on the precipice of some sort of economic meltdown. We're nowhere near anything like that. It really is unwarranted, unnecessary, and silly, frankly.
So from the emotional pulse of the UK media to political tensions brewing across the channel, can you tell us please, what is happening in France and what might it mean for the wider European economy?
Okay, so in brief, Macron called an early election, I believe, last year, and the result of that election basically created a government, a minority government. And so they don't have, by definition, they don't have a majority, so they are really struggling to get a budget through the legislature. So the history here is that last December, a government led by Michel Barnier failed to get its budget through. There was a confidence vote. They lost the confidence vote, and a new government was appointed a minority government was appointed under a chap called Bayrou. He recently presented a new budget, which I wrote about 2 or 3 months ago, and highlighted the challenges that confront France, which has got a budget deficit of about last year it was 5.8% of GDP. This year it's expected to be about 5.6% of GDP. What he has proposed, and by the way, the EU limit is 3% of GDP. So France has got to take action to reduce its budget deficit, but it is finding it virtually impossible to get a budget through its legislature. So these problems are sort of coming to a head again. Bayrou has presented a budget. The budget appears to have no chance of winning a majority because parties on the left and on the right object to the budget and have already said that they would vote against it. So unless some miracle of persuasion takes place in the next few weeks, it looks like that budget will be put to a vote. It will not win that vote, and as a result, well, who knows? They might have to present another budget, or there might be a vote of confidence, and this government might fall. But France is confronting a major problem, and it's a problem for the EU principally. I don't think it's a problem for the IMF, frankly. The problem is that France's borrowing is way above where it should be. The French government found it virtually impossible to institute spending cuts. This new budget, which presents a blend of cuts, spending cuts, and tax increases, it has no way of getting through and winning a majority. So, we are in a very difficult situation in France. French bond yields have risen to a significant premium over German bond yields, reflecting the tensions. 10-year government bond yields in France are 3.5%, roughly 80 basis points above German yields. So, although stressed in relation to, for example, yields in the UK, which are up at 4.7%, some way away from a really distressed level. I'm not quite sure how this situation gets resolved. There is a political problem, clearly, in France that looks like it will only or can only be resolved by new elections and maybe even presidential elections. So I think parties on the right and the left are really squeezing and pushing, I think, ultimately for a broader sort of mandate. So maybe that's how this situation gets resolved. But in the meantime, it's created a bit of stress in the EU, of course, a bit of stress in the French equity market, a little bit of stress in the French bond market, and some concerns about how France extricates itself from this fiscal problem that it confronts. Debt to GDP in France, by the way, is something like 114%, so way above where it is in the UK.
Is this likely to affect European investor confidence, do you think?
I think it is, yes. I think it is having an impact. The French equity market has performed poorly relative to others in Europe this year. It's way behind Germany, way behind Spain, for example, which has performed very well. And indeed, even Italy, which until quite recently was perceived to be the sort of fiscal headache in the EU, but now appears to sort of have lost that title to France. Anyway, yes, it has created some stress, and some concerns about what pressures this puts on what has historically been, a key economy within the EU. France, along with Germany, France is the second largest economy in the EU, and what happens in France is of far greater importance to the overall sort of cohesion of the EU. And even though this crisis is a long way removed from the sort of crisis that Greece, for example, confronted in the wake of the overall global financial crisis, it's arguably more important because, of course, France is so much bigger as an economy than Greece. So yeah, this is a challenge for the EU, challenge for France.
So heading to tech, where there's one company that still seems to be at the center of every story, which is Nvidia. Of course, it's the most valuable company in the world, so therefore its results are probably the most watched set of results on the planet. Nvidia's latest quarterly earnings happened yesterday. Their guidance suggested that there might be a slowdown. So even though their revenues were ahead of expectations, they've guided to something that, the future might not be quite so bright. What's changed and what does it tell us about the AI boom?
Nvidia has delivered an incredible rate of growth, 56% year on year in revenues. For such a big company, that is an extraordinary achievement. Just to put it in context, 56, I think the last quarter, Q2, Nvidia generated $46 billion of revenue. And the forecast for next quarter is about 56, so growth of about 17%, which is still an extraordinary rate of growth for such a big company. $4.4 trillion at the last count. To my mind, this is not symptomatic of a slowdown in the AI industrial revolution at all. It's not symptomatic of a slowdown in spending or investment in the AI industrial revolution. If anything, I see that accelerating. Yeah, I think it's just the product of the law of large numbers. As Nvidia has got much, much bigger, it's just harder to add incrementally larger numbers every quarter to your revenue base. It's still adding something like $10 billion of revenue per quarter on the current estimate for Q3. So that's still an extraordinary rate of growth. But Nvidia is a $4.4 trillion company. It's just the law of big numbers in my mind. So importantly, what the CEO highlighted in his presentation is that he sees the AI infrastructure opportunity over the next 5 years as big as $3 to $4 trillion globally. Now, that's not all $3 to $4 trillion of GPU spending. That's 3 to 4 billion of AI infrastructure spending. Now, Nvidia will capture a lot of that going forward, I'm absolutely sure. But that's a sign of, I think, the ongoing scale of the global industrial revolution that is AI. And I don't see it slowing down. I just see Nvidia's problem, frankly, being the product of it now being a $4.4 trillion company. It's no bigger than that, frankly.
It is one of the things that I guess could help them unlock more growth in the future is China. And we know that the H20 chips we saw a few weeks ago were not. China wasn't taking delivery of those H20 chips and in fact was asking Chinese companies not to use them. How likely is it that China will be unlocked as a market, do you think? Because it's really dependent on the US government and Trump's decision-making in the area.
Yeah, so the H20 chips exports depend upon getting a license from the US government. Also, it also depends on Chinese companies sort of slightly contradicting the government's advice, which is, we don't want to see you dependent on Nvidia chips. We want to see you shift your dependence on domestically produced chips, which everybody acknowledges at the moment are not as good as US-made chips. So, in fact, in Q2, there were no H20 shipments to China, and I don't think the company have guided to any H20 chip shipments to China in Q3 either. So look, this is an opportunity, but not massive in the context, I believe, of the overall scale of Nvidia. I think numbers about $4 billion, I think, were highlighted as the potential for Chinese demand for H20 chips, which in the context of a $4.4 trillion company, is not that significant. So what I suppose the significance here is more geopolitical. Clearly, China's desire to achieve parity on chip technology with the US is clearly very strong, and they believe they'll get there by increasing their dependence upon their own domestic chip industry rather than becoming dependent on Nvidia chips. So I don't really see China being the sort of economic opportunity for Nvidia that it might have presented, say, a few years ago.
So this is not a cooling of the AI wave. This is just, I guess, reframing after some quite extraordinary years for Nvidia and more realistic expectations for the future.
Yeah, look, Nvidia is growing very strongly, but just to put it into context, I think the share prices or the value of the company has risen eightfold in the space of about 3.5 years. So it's been an extraordinary sort of transformation as Nvidia has become the world's largest company, as Nvidia has become the biggest single sort of chip business globally. It's at the center of the AI industrial revolution, and that's happened very rapidly. But the law of big numbers dictates that even if you're adding tens of billions of dollars a year in revenues, because you're so much bigger as a business, the rate of growth naturally slows. The growth rate of the business slows.
Thank you, Neil. Well, we've covered bonds, sentiment in the UK, fiscal drama in France, and the state of AI. Pretty wide-ranging look at where things stand at the moment. And that wraps up this week's W4.0 Weekly Roundup. Neil, thank you as always for your time. And we'll, of course, be back next week with more clarity and context on what's happening in the markets. Until then, thanks very much. Take care.